So the question is when we'll see 2000. I think it's going to be quite some time. But what I'm looking at is the realization we are in a bear market.
Okay, moving on to some more other fundamental issues now. I know this is a trick question by design, but any particular black swan events that you're looking out for that may trigger major moves? I know you can't, by definition, predict a black swan. I think the question is more like, outlier events that you think could possibly happen, but have a low probability of happening, but could still be detrimental to the markets. In either way, maybe it'll be very bullish for gold.
Okay, and so again, can you repeat the question? In other words, what you're asking is
what is an outlier event that with a low probability of happening that could move the gold market dramatically in either direction?
Okay. I mean, there's examples. We had an inclination with the war in Ukraine as Russia, for months prior to their invasion, had amassed hundreds of thousands. What was it at the peak? I think before the invasion was 150,000 troops, but it began with 20, then 50,000, and they kept building it up, saying that they were military exercises. Most analysts and even intelligent analysts in the US and Europe thought that the likelihood that they'd actually pull the trigger and attack a sovereign country was remote. And that's why when the invasion occurred, what was the 24th day of February, that was a black swan event. We saw it building up to the possibility of it happening, but most people doubted that it could happen. The other type of black swan event is when something hits the fan. An example of that is the banking crisis. It took a lot of people by surprise. And when I say people, I mean mainstream traders, that there was a systemic problem in the way mortgages were being written up and issued, and that there was a massive amount of bad debt that was bundled into these mortgage-backed securities. And so when that became news, that was the black swan event. But what led up to it wasn't really a high level of knowledge that lurked on the environment. So a black swan event by event is something that we're not calling to happen. We didn't foresee this occurrence happening, but does happen. In the case of the invasion by Russia, we saw signs of it, but most people didn't believe that they would have the stupidity or the guts. I think it's stupidity, but they went in for whatever reason they went in and they attacked Ukraine. And that was a black swan event. And meltdowns in the US equities markets that were a major day where it crashed, not where you had a defined period of time where you had a defined correction, but kind of where you saw it go down 5%, 7%, 4% in a day, that come out of the blues. Those things are there, they do happen, and they will always occur.
Okay, fair enough. And finally, I promised the audience we'd get your gold price forecast. So let's start with the dollar first, because you mentioned the dollar being a very strong indicator for where the price of gold is going to go. So DXY first, and then we'll go on to gold. Well,
I sent you a 2-month dollar chart that goes back to about 1985. And the reason I did that is at approximately 103, we did see a double top in the market, 2 occasions where dollar strength took it to 103 above, and just shy of 104, it would then retrace and go into a corrective mode. And so on this third instance, which is this recent instance, it did exceed that level and broke back down below it, but only fractionally, and then moved above it. Once it broke really above 105, we got out of that territory, and now we're in a new price high for at least this decade or the last couple of decades. You've really got to go back a number of years before you actually see the dollar being that strong. The one period in time that we can look at, and this is, I believe it's around 2002, back into the 90s, is when it was rising, it rose above 120 on the dollar index. And then when we compare current pricing to historical data, what you see is there's only been a couple of occasions in which it went above that and then back below it, but going through that wasn't a substantial top. In other words, because the last time gold traded at a certain level, that is an important data set or fact that we need to be aware of. But it's, for example, the high of mid-2011 at 1920, that became a benchmark area because that was a new historical and all-time record high. So when it went past that, that became a major level of support. When it trades below it, a major level of resistance. There's certain areas that are just price points that it goes through, but you can't define it because of a top or bottom in the market. And that's where the dollar is right now. The major top in the dollar occurs at about 120. We're sitting just above 107. What I have been looking at, because we haven't seen the dollar value be this strong in years and decades, and historically speaking, when we looked at when the dollar was last there, it was either there as market was rising or falling, and the top was well above that. It's not a major area of resistance based upon a historical top in the market. And because of that, you have to look at where that top is, and then you have to define how long it has taken since we have seen that to get an idea of the probability of it reaching 120 again. And then you have to look at the underlying fundamentals behind it. Right now, dollar strength has been a direct result of the Federal Reserve raising interest rates because we had yields, real yields on 30, 10-year notes, 30-year bonds, basically at 0, 0.25%, 0.5%. They weren't bearing any kind of real yield where they entertained a lot of people getting that as a fixed investment, or institutions putting that on as a fixed part of their portfolio.
Yeah.
Now that there's actually some yield in there, you get a lot of interest, and that interest is what has taken the yields on US debt instruments higher, and is what has attracted investors to go back into that pool and to look at that as a viable investment. Gold doesn't yield interest, and therefore there's an inverse relationship between rising rates and the price of gold.
Okay. Yeah, that makes sense. Gold is a non-interest-bearing asset, so it hedges against any interest-bearing asset that is impacted by inflation. So if real rates go up, gold tends to go down. Let's talk about then your gold price forecast. $2,000 gold. Is it going to happen next week, next month, next year?
No, the question right now is how low will gold go before it finds support and either tracks sideways or bounces back to the upside. I've got a couple of numbers that I've been looking at. One of the numbers was 1720, and that was based on a series of lows that we've seen over the last 3 years. I believe that the market hit a low of approximately 1721 recently. And so that's a level that we're looking to see whether or not it holds. I think that there is not a tremendously high probability it will, but it could. It's an area we want to look at for potential support. However, if it breaks below that, my eye is on $1,680, which matches the low of the flash crash we had last year, where we saw gold sell off dramatically in one day and then actually close well above that low. The low was at 1680 and the closing price was around 1720. So it's another reason that those are important numbers to me. So the question is when we'll see 2000. I think it's going to be quite some time, but what I'm looking at is A, the realization we are in a bear market, and B, and most importantly, where could support come in and what would fundamentally need to happen for that support to come in. And what I mean by that is I'm a hybrid analyst, meaning I look at fundamentals to shape the direction, whether it's moving up or down of any given commodity. It's going to be fundamental events that shape the direction. The technical indicators tell me where that could conclude or where the places stop. So what needs to happen fundamentally? there needs to be a shift between market sentiment focusing upon rising rates and begin to focus upon exceedingly high levels of inflation. That is really the underlying fundamental events that need to occur before we see gold finding a bottom and beginning to move up, back up. What would do that? And the answer to that is rising rates amidst the point where inflation remains elevated. In other words, if in fact inflation is sticky and persistent, and if the systemic reason that we're looking at inflationary, and I'm talking about headline inflation, meaning including food and energy costs, are above 8%. And the Federal Reserve, let's say, raises rates to 2.5%, 3.5% by the end of the year, but inflation remains completely elevated. It doesn't have to go higher, but if it remains at the current level or it doesn't tick down that much, at some point, there will be a basic shift in market sentiment in which they're not focusing upon rising rates, but high levels of inflation. And that's the fundamental change that has to occur before gold prices bottom.